We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Last week, the S&P 500 entered correction territory, which is defined as a 10% drop from the previous market peak. Throughout my entire career at PlanCorp, I've sent out an email when the S&P 500 experiences a 10% loss to remind people that there's no reason to panic and the best thing to do is stay the course. Now, every time I send this email, I joke internally with my teammates to, quote, wake me up when we're down 30%, because I know that 10% losses happen roughly every other year, and that the average intra-year drawdown for the S&P 500 since 1950 has been 13.7%. I see these temporary losses as being incredibly normal and simply the cost of higher expected returns stocks provide. And my most loyal followers hear me say this all the time. They also hear me say that we can never predict when or why the next correction will occur. So instead, we plan on them occurring with a similar magnitude and frequency as they have in the past. But even though many people hear me say these things repeatedly, living through market volatility in the moment is quite different, and it can be tempting to change course because every correction seems uniquely scary. So that's why I've historically sent out an email communication when the market crosses the 10% loss threshold. But last week, I didn't send that email, because the major headline at the moment losses eclipsed that 10% mark was the Russian invasion of Ukraine. But market reactions to geopolitical events tend to be short-lived, and in my opinion, the drivers of the market correction were more nuanced than the Russian invasion alone. Fortunately, a podcast format allows me to more easily address these nuances, so I'm going to do just that by putting the recent losses in historical perspective, explaining the role Russia and Ukraine play in the current market environment, and finally, sharing some thoughts about where we go from here. When I'm sending out an email about a correction, I typically make the same 4 points each time, regardless of what's going on in the world at the time. The first is that I always put the market news in historical perspective. In this case, geopolitical events dominated the headlines when the S&P 500 loss crossed the 10% threshold. Even though I don't think Russia and the Ukraine are the biggest drivers of the U.S. stock market correction, I'll still provide some resources on that front. There are 3 great graphics I've included in the show notes on thelongterminvestor.com that show how geopolitical events rarely have lasting impact on markets. The first one's from JP Morgan, and it shows S&P 500 sell-offs around geopolitical events. It has the start of a sell-off, the duration and size of the sell-off, and the duration to recover to the prior level. The second one is from Vanguard, and it looks at losses during 8 specific geopolitical events, starting with the Cuban Missile Crisis in 1962 through the 2016 Brexit vote. This chart looks at the initial loss and then the returns 6 to 12 months after the event. The third chart is from AllianceBernstein, and is probably the most comprehensive in terms of different types of geopolitical events. That one is definitely worth checking out at thelongterminvestor.com. But if I were writing an email, the type of data I would use is in a fourth graphic that shows how stocks tend to perform following corrections of 10 to 15%, regardless of why they fell 10 to 15%. So that covers the first point I typically include in a correction email, just by putting current events into perspective. The second is that reacting to losses can hurt performance. Even if you could accurately predict the future, knowing how the market will react is impossible. And going to cash requires you get it right twice. Once when you sell stocks, and once when you buy back in, making an already tall task insurmountable. Plus, the best days for the stock market historically follow the worst days. And missing out on returns from the best days basically locks in permanent underperformance versus the overall market. The third point I typically make is that losses are normal. And I alluded to this earlier, and it feels like I've said it a million times. Looking at S&P 500 data going back to 1926, double-digit losses occur in 65% of calendar years, and nearly a quarter of the time, losses are greater than 20%. I also referenced earlier that the average intra-year loss for the S&P 500 since 1950 is 13.7%. These losses are the cost of higher expected returns for stocks versus bonds and cash. And there's no way to predict when losses will occur, but you can plan on them occurring with a similar magnitude and frequency as they have in the past, which leads me to the final point in a typical market correction email, which is if you're feeling concerned, the first thing you should do is review your financial plan, not your portfolio. There's no way anyone could have perfectly predicted the variety of events that have occurred over the past 2 months that have contributed to market losses, but we did plan on these types of losses occurring and built investment strategies accordingly. But in building those portfolios, we assume that investors will stay the course, so changes to portfolio strategy are very harmful. That's why it's important to look at your financial plan first. If nothing has changed in your financial plan other than market prices being lower, then there shouldn't be a need to make changes to the portfolio. And that last point is arguably the most important, and it's something that I always conclude with in a volatility-related communication. Because the world is constantly changing, but good advice remains the same, and that's largely because financial theory tends to play out over the long term. The challenge is that the long term feels like an eternity in the moment, particularly when things feel more uncertain. So to summarize those 4 main points I typically make in a market correction email, the first is that stocks tend to perform well after a 10 to 15% correction. Reacting to losses can hurt performance. Losses are normal. And finally, the best action is to review your financial plan. Now, let's dig a little deeper into the nuances of the recent market moves, and I'll start by performing an autopsy of sorts. I recently wrote about how expert predictions are complete nonsense, which seems timely because it's common and maybe even expected for financial experts to give concise after-the-fact narratives explaining in great detail and certainty what just occurred in markets and why. Then, they turn around and tell you what will happen in the future. I'll go ahead and link to that article in the show notes, but by doing a market return autopsy, I'm hoping that we can largely ignore narratives and instead simply focus on drivers of stock market returns. Stock market returns, whether they are positive or negative, are driven by 3 things: changes in earnings per share, cash returned to shareholders via dividends or share buybacks, and changes in valuations. There are a number of ways people will measure valuation, but the most common one is price to earnings or PE ratio. Today, the S&P 500 has a PE ratio of just under 25. So that means investors are willing to pay about $25 for $1 of earnings. The vast majority of S&P 500 return in 2019 and 2020 can be attributed to multiple expansion, which simply means that in those years, investors were willing to pay more and more for $1 of earnings. It wasn't until 2021 when the S&P 500 started with a PE ratio of nearly 36 that multiples began to contract, meaning that investors began paying less for $1 of earnings growth. The PE ratio that year fell from roughly 36 to 26 over the course of the year, which subtracted about 8 percentage points from the 2021 return. Now, despite that multiple contraction, the S&P 500 still managed a total return of 28.71% in 2021, as earnings growth contributed over 30 percentage points to return. Now, I only have these breakdowns in full year data, so I can't perform as precise of a market return autopsy for the 2 months since the S&P 500 peaked. But I can see that 1, earnings growth has slowed a bit, but is still positive. 2, cash return to shareholders appears to remain relatively stable. And 3, valuations have contracted. In my opinion, that's the important piece. The primary driver of recent market losses has been changes in valuation. So now the question is, why are valuations contracting? Well, the Russian invasion was on people's radar earlier this year, but I believe the bigger driver in valuation contraction has been the decades-high rate of inflation and the shifting expectations towards how the Federal Reserve might respond. After spending multiple decades below its historical average, the latest inflation report showed year-over-year inflation of 7.5%. Even though that is higher than the previous 12-month inflation number of 7%, the month-over-month inflation data has actually been falling since last fall. But above-average inflation still seemed likely, so the Federal Reserve has communicated very clearly that they will begin tightening monetary policy more quickly than previously expected. In my opinion, this is the primary reason market valuations have contracted. As the Fed raises interest rates in an effort to cool the economy, it just so happens that earnings growth is also cooling right now. And so the sentiment on future, along with the price investors are willing to pay for $1 of future earnings, has contracted. But the Russian invasion does complicate things a little bit, since they're the world's third largest oil and second largest natural gas producer. They also control half of the world's palladium supply, which is used in cars where supply chain problems are already pushing prices higher. Plus, Russia and Ukraine represent more than 25% of the global wheat market. The Fed is widely expected to raise interest rates in March, but the Russian invasion has market observers pricing in less aggressive rate hikes now. So where do we go from here? As always, where we go from here is completely unknown. There are so many variables in play, and even if you could correctly predict the various outcomes, it's impossible to know how the market will react to each outcome and how those reactions will interact and influence each other. Assuming there isn't a full-fledged world war, the annexation of breakaway states does not appear to be a substantial threat to markets. Pair that with a growing sense that COVID cases are in full retreat and the economy is set to fully reopen again, and you could easily paint an optimistic picture for near-term stock returns. On the other hand, we can't know that the Russian conflict won't escalate or that a new highly contagious variant of COVID won't pop up. Plus, the Federal Reserve removing monetary stimulus will likely dampen economic growth in general. Considering that the S&P 500 has enjoyed roughly 13% annual returns over the past decade, some mean reversion towards the long-term average returns should be expected. But how things play out over the next 12 months isn't nearly as important as how things play out for the next 5, 10, or 20 years. This type of short-term uncertainty is what drives higher returns in stocks compared to bonds and cash in the long run. If you have any comments about today's episode, please feel free to leave a review in your favorite podcast player. You can also visit thelongterminvestor.com to submit questions, comments, subscribe to my newsletter, or find past episodes and show notes. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.